The next structure on this playlist is the exact opposite of the last one. The last one was a low volume node or fair value gap, an area where not a lot of trading activity had taken place and the price had moved aggressively away from that, creating an imbalance. This is actually an area of balance where there's a lot of congestion, and the implications of that are that there are a lot of people in positions there. They've established longer term positions, and once the price moves away from that area, they have to either liquidate, or once the price comes back to that area, it can be used as an area where there's an opportunity to trade against those people who are now going to exit their positions. How do we identify that? Well, if a fair value gap is an area where the price moved rapidly away from, like right here, a low volume node. A high volume node is an area where the price had spent a lot of time. So this congestion here is essentially a range where traders have put positions on. We can also use a fixed range volume profile indicator to see that. There's certain settings on the way that this indicator is set up. You can message me for more information on that. That actually shows really strong areas of support and resistance. Like you can see the market trends up here, and it's a great reversal opportunity. But you can look and see these congestion nodes where all the volume had taken place. There's a lot of activity there, which is essentially this range right here. And then as the market comes back up to it, this functions as a pivot. I use this on both short and long-term time frames for major reversal levels, areas of perceived value where we should be very careful maintaining our positions or look for reversals, and then actually on a short-term time frame to see areas where to enter responsively in the direction of the current intermediate trend. We can then also use these as failure levels in the same way. So in this case, there's an area of accumulation, high volume node right here. The market should respond to that, and we see that the price does bounce there, but then when the price goes underneath that, that's inverted. So every trade that would have otherwise been established in this area is now broken, and the intermediate direction is now down, and we would shift our overall market interpretation to be in the downside, and then this also functions as resistance once we come back up here. That's using it on a long-term time frame. We can go through and check a couple other examples, and just very roughly, not going into too many of the details here, but we see that this works here too. Once the market comes up above this and then reverses that as a pivot, this becomes resistance. And again, very straightforward in this example. The market had an accumulation in this area. It comes above it, and this is an area of support. And then we see that once that inverts, well, in this case, there was only a short-term intraday action there, but you do see that the market pulls back below this and comes back up to this level and then pulls back again. These moves don't look like big moves, but this move from here to here is something like 60 points, which is definitely tradable on the intraday time frame for the NASDAQ. The way that this indicator is set up, you can use these as little range zones, but it's not necessarily these blue lines. It's also these pivots of just where these nodes stick out. So we can mark this like this and see that after the market pierces below that convincingly, we get a push up into that, and that becomes resistance in there. See that the market does pull back, touch that little green square, and then come back down. For more details on how to use that on the longer term time frames, we do go into that in the overall trading system videos and documentation there. But now we're going to move on to the short term time frame and show how that works trading in the direction of the intermediate trend. We're actually down to a 15-second chart, and we see the exact same thing. This is an area of accumulation, and then once the market breaks down below that, we can look to sell that on a retracement there, and that functions as resistance pretty convincingly. And if we scroll to the right, we can see that this still is resistance. Every time the market pushes into that, there's a pullback in there. We do use these as flips, like once the price is flipped underneath or above the value, we can then imply that there's an immediate reversal on that. But as long as they hold, we're actually good for following the trend. So we see that from this downtrend, the bottom here, there's accumulation here. The market doesn't actually pierce into that. Then we can see that as this market goes up above this, there's an accumulation of congestion here, and there's a buy point there. And as the market continues up, this right here would look like potentially a reversal if you're seeing new lows. That's a short-term flip of that trend. But you can also see that it actually just moves into the highest volume node of this trend and then bounces in this value range and then continues higher. So these are great reference points that we use as part of the overall system, something that you really need to be aware of in the documentation and your market preparation process, making note of where these occur and then how the market responds around those on both short and long-term time frames. This is an example of a value flip. So here's the congestion. This is the value zone. Market pushes up here. It hits into that big response to that. Once we go below that, that is actually a trend shift. And there's a lot of people that get sucked into this. I mean, I've been one of them for years until I figured out the system where, this is all support. Oh, it's support, it's support. You buy this and you buy this and you buy this. And every time you buy this, it just keeps going down. If you recognize this as a trend shift, you use it as a trend filter. Now the market is going down and you can just sell that until it breaks above that, and then things have changed. This is another great example. You don't see it yet, but as the market continues higher, this is the area of congestion. Okay, we're buying that potentially in this case. Just an example. Okay, we're below that. Should we keep buying it? Well, this might be support from other structures, and actually that's broken at that point. The market just pukes. So a good way to keep yourself safe is to not trade against these. Another example on the short-term time frame, this is a downtrend congestion here. Had you bought this, let's say that this is a more major reversal level and you're trying to buy that. So you can actually use that as a place to enter once the value on this is flipped. Okay, we're above that, maybe you're entering here. Where should you take off? Well, you need to be very aware in these congestion levels of where you want to be either taking off or at least not entering new positions. As the markets come above this, had you bought here, you would have eaten like a 20 or 30 point drawdown from that, and maybe that's going to knock your account out unnecessarily. Whereas if you're more patient and wait for that to flip around, you can now enter right here on the inversion of that. So that's how to use that as a trend filter as well as an area to enter. And then we can see, like, let's say we think this is support, which it actually is for a longer term structure that we're not going to go into. And we see that the market's kind of accumulating itself higher here. We can use these congestion nodes as points to enter. So let's say you want to buy this because you think it's going to break higher. Where should you enter? Well, inside of this congestion node, clearly. So the market's coming up here. Should you be trying to buy that high? No. If you think it's going to break above that high, which it did, where should you be trying to enter? You should be trying to enter at a good price, being a little bit more patient. And these congestion areas are where a good price is. That's essentially how they function. It's an area of trapped traders, accumulated traders that we can ask ourselves, where's a good price to enter in this current dynamic? And these give us an example of that. We can also use them to identify what's the current dynamic. Once these have shifted, it's a subtle shift that many people don't necessarily recognize, and that's how they end up getting trapped. Exact thing happened here. If you think this is the value area, which it is, and you think it's support because it is, should you be trying to enter here? Yes. Once it goes below that, this is actually shifted, and now it's going to go find longer term value. It's going to go find some other reference point. This is now a downtrend, and you should no longer be trying to buy this. In fact, you should actually be trying to sell this. So we use it as an area of perceived value, both in long and short directions, on both long and short time frames, and then also as an indicator of what the current dynamic is, whether or not we're in an uptrend or a downtrend, with reference to the immediate market conditions, which is what we need to be trading, not speculative conditions, not things that may or may not happen. We use this as an identification as part of the overall system to see where's the market going, what's it doing currently, and how should we enter. This is another tool in our toolbox to do that. I hope this was helpful. Once again, this playlist is a collection of different structures that we use to implement our system profitably intraday on the NASDAQ, really only trading NASDAQ futures currently in different funded accounts for different prop firms. And yeah, hope this was helpful. Like, comment, subscribe, etc., etc. Thanks for watching.